Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Everyone dreams of finding that next big stock, turning a modest investment into substantial wealth. It's a common aspiration, and while the stock market offers incredible opportunities, picking, winning stocks isn't about guesswork or pure luck. It requires a thoughtful, disciplined approach. This isn't to say it's easy or without risk. The market can be unpredictable, but investors can improve their odds by understanding what drives stock performance. It comes down to focused research, careful analysis, and a clear investment strategy. This guide aims to show you how to build that methodical approach. Laying the foundation. Understanding your investment philosophy. Before you even think about specific stocks, it's essential to understand yourself as an investor. Your personal situation, financial goals, and comfort with risk form the bedrock of any successful investment strategy. Without this clear foundation, even the most promising stock picks might not align with your true needs. Defining your investment goals and time horizon. What do you want your money to do for you? This might seem simple, but your financial goals directly influence your investment choices. Are you saving for a down payment on a house next year? Or are you building a nest egg for retirement in several decades? Different goals require different financial approaches. For instance, short-term goals often call for less volatile investments. Long-term goals, however, allow for more potential growth and can weather market ups and downs. Be realistic about when you need access to your funds. This time horizon is a critical factor in deciding how aggressive or conservative your investments should be. Here are some common financial goals. Retirement savings. Planning for a comfortable life after your working years. Buying a home. Saving for a down payment. Child's education. Funding college or other educational expenses. Major purchase. Saving for a car, boat, or extended vacation. Building wealth. Simply growing your money over time to improve financial security. Assessing your personal risk tolerance. How comfortable are you with the idea of your investments losing value, even temporarily? This is your risk tolerance. Everyone has a different level of comfort with market fluctuations. Understanding yours helps you avoid making impulsive decisions based on fear or greed. To assess your risk tolerance, consider these questions. How would you react if your portfolio dropped by 10% in a month? Do you prefer steady, modest returns, or are you willing to take bigger risks for potentially higher gains? How much sleep would you lose if your investments were performing poorly? Generally, investors fall into one of three profiles. Conservative. You prefer preserving capital over growth. You might favor stable investments with lower returns but minimal risk. Moderate. You seek a balance between growth and safety. You're comfortable with some market fluctuations for better returns. Aggressive. You aim for maximum growth and are comfortable with significant market ups and downs. You understand that higher potential returns often come with higher risk. There are many online questionnaires that can help you gauge your risk tolerance. It's important to be honest with yourself during this assessment. Identifying your investment style, growth, value, or income. Once you understand your goals and risk tolerance, you can start to think about your investment style. This refers to the types of companies and strategies you'll focus on. The main styles include growth, value, and income, with speculative investing on the more aggressive end. Growth investing. This style focuses on companies expected to grow sales and earnings at a faster rate than the overall market. These companies often reinvest profits back into the business, so they may not pay dividends. Growth stocks can be more volatile, but they offer the potential for significant capital appreciation. Think of innovative tech companies or emerging industries. Value investing. Value investors look for companies that appear to be trading for less than their intrinsic worth. They believe the market has undervalued these stocks. These companies often have strong fundamentals but might be out of favor or in mature industries. Value investors seek to buy good companies at a discount, expecting the market to eventually recognize their true value. Income investing. This style prioritizes regular income from investments, typically through dividends or interest payments. Income investors often choose established companies with a history of paying consistent dividends or bonds. This approach is generally more conservative and can be suitable for those seeking a steady cash flow, such as retirees. Speculative investing. This is the riskiest style. Speculative investors chase potentially high returns from highly volatile or unproven assets. This might involve penny stocks, cryptocurrencies, or new companies with unproven business models. While the allure of quick gains is strong, the risk of substantial losses is also very high. This style is usually only suitable for a small portion of an aggressive investor's portfolio, if at all. Your investment style should align naturally with your risk tolerance and financial goals. For example, a conservative investor looking for retirement income might lean towards value and income stocks, while an aggressive investor with a long time horizon might favor growth stocks. Comprehensive research and analysis, digging deeper. After you understand your investment philosophy, the real work of picking stocks begins with thorough research and analysis. This step moves beyond your personal preferences and dives into the specifics of companies and the market. It involves looking at hard numbers and also understanding the less obvious aspects that drive a company's success. Think of it like being a detective, gathering clues to build a complete picture before you make a decision. Fundamental analysis. Deciphering financial statements. To truly understand a company, you must look at its financial statements. These documents are like a company's report card, showing its financial health and performance. The three main statements tell different, but equally important, stories. The income statement, also known as the profit and loss statement, shows a company's revenue, expenses, and profit over a period, usually a quarter or year. You can see how much money the company made, what it spent, and ultimately, its profit margins. A growing revenue and healthy profit margin often indicate a strong business. The balance sheet provides a snapshot of a company's assets, what it owns, liabilities, what it owes, and shareholder equity, what belongs to the owners, at a specific point in time. This statement reveals a company's financial structure. Look for a reasonable balance between assets and liabilities. The cash flow statement tracks the actual cash coming into and going out of a company. It breaks down cash flows into three main activities: operating, investing, and financing. This statement is critical because it shows if a company is generating enough cash from its core business to fund its operations and growth, rather than relying on debt or selling assets. By examining these statements together, you gain a clear view of a company's financial story. Are sales growing? Is debt under control? Is the company generating enough cash to stand on its own? These are the types of questions these statements help answer. With the right approach, you can build a portfolio that grows steadily and withstands market shifts. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.